Hello friends, in this video, I would like to explain what you as an investor should look at before buying pharma stocks for your portfolio. We have curated a list of 7 best pharma stocks to buy, which are Dr. Reddy's, Divi's Laboratories, Cipla, Biocon, Aurobindo Pharma, Cadila Healthcare, IOL Chemicals and Pharmaceuticals Limited. This list of stocks is for a long-term horizon, keeping several fundamental factors in mind. As an investor, this video will guide you to make your own checklist and research these stocks better. Firstly, a brief on pharma sector. Outbreak of the current pandemic has brought back the attractiveness of pharma sector as a whole. The rise in demand of especially a few essential drugs gave the much needed boost to the sector. Pharma sector is arguably one of the least affected in the COVID-19 situation, and a strong demand for essential drugs would aid the growth for companies. Pharma companies can be attractive for long-term investors in spite of the volatility. The ever-rising industry and healthcare becoming a critical part of life, investors can make good returns if they invest at the right time. Hence, an investment in an evolving industry which is undergoing numerous innovations and scientific breakthroughs with technological advancement can be a game changer of exponential growth in your portfolio. But not all companies will give you the desired returns. Hence, you must pick companies which are fundamentally sound with resilient balance sheet, proven track record of clearance from US FDA issues and management expertise. Companies should also have a growth visibility in terms of pipeline approvals, patents and cash buffers to cushion themselves from any downturns. Factors such as consistent high return ratios, lower debt to equity ratios, profit margins, R&D expenditure, drugs at various stages of approval in the pipeline, etc. should definitely be checked before investing in a pharma company. Now let's look at a few factors in detail. Firstly, the top line and bottom line. The top line refers to company's revenue, while the bottom line is the company's net income. It is important to pay attention to them for signs of any changes from quarter to quarter and year on year. Any significant decline should be a red flag which would need a deeper look. Consistent growth is what an investor should look for. For instance, Aurobindo Pharma, a leading US generic player with a strong presence in developed markets like Europe, has a top-line CAGR of 19.32% and bottom line at a CAGR of 15.65% in past 5 years, which is a good by pharma standards. Next we come to operating profit margin. This is also known as operating income margin, which is a measure of how much profit a company makes after deducting its variable costs of production. A company needs a healthy margin in order to pay its fixed obligations, such as interest on debt and taxes. A high and improving operating margin is an excellent indicator that a company is being managed well. Divi's Laboratories, which is the largest Indian contract research and manufacturing service player, has consistently improved and tried to maintain its operating profit margin over the past 5 years in the range of 34 to 38%. Now moving on to return ratios such as ROE and ROCE. Now both these ratios are used to measure the efficiency with which a company can generate profits. Now these ratios are of utmost importance, which should be compared with industry peers to pick the best bets. The trends of this ratio should be looked at to see if they are improving or not. Now you can see that companies in our model portfolio have clocked a healthy return ratios. Coming on to price to sales ratio. This is a key valuation matrix. Price to sales ratio measures the value that an investor receives in comparison to how much he pays for the stock. This can also help in understanding if a stock is overpriced, fairly priced or underpriced relative to the company's true money-making potential. Looking at our model portfolio, you can see that Divi's Laboratories is overpriced when compared to others, whereas Aurobindo Pharma has the lowest price to sales ratio. The next matrix to look at is debt to equity ratio, which helps to determine as to how company finances its assets. Too much debt can pose a risk to a company if it does not have the ability to consistently generate earnings or cash flows to meet its debt obligations. It is seen that all the stocks in our model portfolio have no or low debt levels. These companies will enjoy a higher valuation compared to highly indebted ones, since they'll be able to conserve cash and reinvest instead of paying interest obligations. These cash reserves will help them to fight against uncertainty and unprecedented times like this. Inventory turnover ratio shows how fast the company has been able to sell and replace their existing inventory. For rapid increase in sales, inventory should be churned faster. A lower turnover implies weak sales or possibly excess inventory, while a high ratio implies either strong sales or insufficient inventory. A turnover ratio which isn't too high or too low would be ideal for this sector. Companies in the model portfolio have inventory turnover ratio in the range of 1 to 2, while IOL Chemicals is an exception with a ratio of 5.6. Coming on to research and development. Now, good quality, consistent research and development is crucial to the long-term success of a pharmaceutical company as well as the pharma industry as a whole. It is seen that Dr. Reddy's Laboratories has spent the highest percentage of revenue from operation in research and development, followed by Cadila and Cipla. The two engines of the sector, export to the US and domestic sales, has been fired at full blast from financial year 2009 to financial year 2016. These engines slowed down between financial year 2016 and financial year 2019 and are currently at the bottom of both in terms of valuations and business cyclicality. Earnings recovery is expected from financial year 21-22 because of local demand, improvement in US generic business, cost rationalization, as well as depreciating currency. It is expected that faster ANDA approvals and supply opportunity would emerge given the increase in drug shortages, which may emerge as a tailwind in US generic business. Now this, coupled with faster approvals for facilities having minor issues, would act as a catalyst. Additionally, high capex and R&D along with slower approvals and regulatory issues had compressed the return ratios in past few years and is now expected to improve over near to medium term. All these factors sum up to how an investor must pick pharma stocks for their portfolio. A checklist of various fundamentals, both from micro and macro perspective, would help you to pick up the right stocks for your portfolio. Thank you.